All right, let's get started. How are you guys all? Good. So it's nice to be back again. So in the last 3 online classes, you guys watched some webinars and lecture video, right? Any questions so far? So in the last lectures, we were talking about international Fisher effect. So when you say Fisher effect, we're actually talking about nominal interest. And according to Fisher, there are only 2 components in the nominal interest. One is real interest rate, and the other is expected inflation. So what is a real interest rate? You can say it's a rate that is compensating you to defer your consumption, right? If you have some savings today, you can either consume or you can either invest. For deferring your consumptions, you're making the investment decisions. Real interest rate is basically the compensation to defer your consumptions. On the other hand, inflation estimates the persistent price change. Any persistent change in the price level is known as inflation. According to Fisher, nominal interest should have these 2 components. Whenever we see any interest rate, maybe for our bank deposit, bank loan, whatever, we are actually talking about nominal interest rate. Now, if we convert this concept globally, each country offers nominal interest rate on their investment, right? If you put money in US versus UK, each country offers nominal interest rate if you put money there. And for each country, if we assume the real interest rate is similar, like similar amount, because for each country, if investor demand similar rate to defer their consumptions, they should get similar amount of real interest rate. If we assume these 2 are same across different countries, then any changes in nominal rate between 2 countries or any differences in nominal rate between 2 countries is basically a function of differences in expected inflation between 2 countries. If US has higher nominal interest, that means US have higher inflation. As against any other country, could be Canada, could be UK, could be Australia. So from purchase power parity, we know the impact of inflation, right? What is the impact of inflation on the spot rate? If we use the same learning, we know that for international Fisher effect, when home country has higher interest rate, that should translate into appreciation in foreign currency spot rate, right? Kind of similar learning from purchase power parity because of impact on inflation side. So in the last class, we basically covered all of these. I just wanted to give you a refresher so that we can talk about today's stuff. So, according to international Fisher effect, what do you know? Any country having higher interest rate against some other country should see what? Appreciation in the foreign currency But do you think it always holds? What are some limitations of international Fisher effect? The very first limitation of international Fisher effect is this main component. The very first limitation of international Fisher effect is the main component, which is pressure. If we go back, January 2020. How many of you expected inflation should be that high? Even on the economists, right? They expected inflation could be more, because they're printing money, they're giving a lot of stimulus, right? People are having more money. At the same time, production completely shut down. So that means there should be inflation on the economy. But how many of us exactly anticipated or predicted the expected inflation? So if we don't know the main component of the Fisher effect, then how can we expect or how can we estimate what should be the changes, appreciation or depreciation in the foreign currency, right? Is it possible? Sometimes Fisher effect hold, but if you talk about if it holds exactly or not, it's a tough job. Second limitation, which is the limitation of also purchase power parity. Changes in spot rate is not only dependent on inflation. There are a lot of other factors, right? Income level, expectation, government intervention. So that's why in real life, it's really, really tough that international Fisher effect holds. Question so far? Now let's talk about the other dimension, the other reality of Fisher effect. What is the interpretation of this graph again? How can we interpret this graph, this international Fisher effect graph? If home country has higher interest rate, let's say home country USA has 10% interest rate, UK has 8% interest rate. What should be the impact on the spot rate of the foreign currency? How much? 2% appreciation. UK spot rate as against USD, right? What is the explanation here? Why it happened? Because of inflation, right? If we think about from a different dimension, think about investor, not consumer. So far we think about consumers, right? Consumers prefer to buy their goods and services from the location where it is cheap. Now, if we think from the perspective of investors, and if they have savings where they want to invest, In lower interest rate country or higher interest rate country? High interest rate country. In that regard, investor in USA, they want to keep money in USA. And also investor from UK, they want to send money to USA, right? And then if there is higher demand for US currency, do you think British pound going to appreciate or US going to appreciate? US going to appreciate? So that is one of the harsh reality of international fishery effect. If you read the first point, a country with a high interest rate can attract more capital flows, more foreign investments in terms of portfolios. And that can rather strengthen the home currency. So that's one of the harsh reality that international fishery effect may not hold. And also, sometimes countries or central banks can intentionally increase the interest rate so that they can attract more capital flows. So these are some limitations. So if you want to think about international fishery effect, and if you want to explain from this factor, countries with high interest rate should have high inflation and should experience depreciation in their currency, appreciation in the foreign currency. But on the other hand, if you only think about interest rate dimension, countries sometimes attract more capital flows from the outsiders. And as a result, they may see more demand for their home currency, which may strengthen their home currency. So this is one of the reality that why fishery effect should not or may not hold. Make sense? Now, if we combine the three effects, the three theories we learned so far, and what is the implication? What is the differences? So far, we learned interest rate parity, purchase power parity, international trade, right? What do you learn from interest rate parity? If there is a nominal interest rate differential today between two countries, and depending on that, there should be a forward rate premium or discount, right? And we'll get to know what should be the forward exchange rate movement between two countries, right? That is the interest rate parity. When you talk about purchase power parity trying to say that if there is a difference in inflation, consumers would love to move to the country where goods and services are cheap. As a result, spot rate between these two countries will be adjusted. On the other hand, international fishery effect is trying to say that the differentials in nominal interest rate is coming from the differentials of expected inflation. And if this is true, we can apply the same argument of purchase power parity. That higher interest rate is coming from higher inflation, so that home currency will experience depreciation in their home currency and appreciation in the foreign currency in the spot rate. So be careful. You have to identify of these three theories, what is the source of discrepancy? The source of discrepancy for interest rate parity is, right, nominal interest rate differentials. Source of discrepancy for purchasing power parity is inflation rate differential. The source of discrepancy for international Fisher effect is nominal interest rate differential that coming from changes in expected inflation. What is the impact? Interest rate parity affect forward premium or discount, which is a direct impact on the forward rate between two countries. And the other two affect current spot rate. To make sure for these three theories, know the underlying assumptions and intuitions. What is the key source of discrepancy and what is the impact? Makes sense so far? Any questions? Interest rate parity, purchase power parity, international Fisher effect. Now we're going to move on to chapter 9. So in chapter 9, we'll talk about forecasting exchange rates. So basically, when we say forecasting exchange rate, that means we want to see what should be the exchange rate tomorrow, right? So if we want to give you some heads up, do we know time series analysis, time series forecasting? Time series analysis, time series forecasting? No idea. We go here. Okay. So this is the real graph between the exchange rate of British pound and USD. So how can we interpret this graph and what this graph is trying to show us? What you can think of? This is the daily graph, okay? It's only on today. I can switch to in any dimension you want to see. Let's see. This is a monthly graph. So this is trying to tell you what? What it is trying to tell you. Huh? That's it. That's the only thing it tells. So $1 is, sorry, £1 is $1.24, right? £1 is $1.24, right? So here we have the US is the home currency, right? So the very first implication of this graph is this is trying to tell you on a daily basis, each day, what is the exchange rate between pound and dollar. Okay? Exchange rate, daily basis. So when we look at any one asset over time, that data is called time series. How many assets we're looking at? One, right? The exchange rate between pound and dollar. And what is the time dimensions? Are we only looking at one point in time or over the time? Over the time? This is time series data. So I can increase it like 1 day, 1 month, 1 year, 5 years. This is yearly data, but it's trying to show you each month how the exchange rate is moving. Now, given the historical time series data, this is the current value, right? So current value means t equals to 0. Right, today, 0. If I ask you what should be the value tomorrow when t is equals to 1? Any idea what should be the value tomorrow? Huh? Say it loud, it's fine. Do some brainstorming. We are here to learn. If we say what should be the value tomorrow, expected rate of growth or whatever, right? Well, how can we do the expected growth? How can we find that? Absolutely. Nobody knows, but we have to calculate. So, staying today at T0, looking at the historical data, if we try to learn what should be tomorrow, this is called time series forecast. Make sense? So what is the time series forecasting? Staying today of one asset, looking back what happened. If we want to see what is going to be tomorrow, if we want to learn, this is called time series forecasting. In this chapter, we will learn why any corporations want to forecast the exchange rate for tomorrow. So tomorrow doesn't mean only confined to tomorrow. Tomorrow means it could be 1 month, 6 months, 1 year, right? Depending on the investor's need. If they want to see the tomorrow or future, why they want to see and how they can see. These are the two big learning objectives we're going to learn from this chapter. Questions so far? So do you know what is time series forecasting? Now let's move on why corporations need to do time series forecasting of the exchange rate. First important reason, hedging decisions. Even if any corporations do not have any subsidiaries across globally, even if any corporations do not have any subsidiaries in other countries, sometimes they rely on other countries for supply or sales. Because sometimes they buy raw materials from foreign countries, or sometimes they make international sales, right? Is staying in the home country. In that case, if today they purchase any goods in credit, or if today they sell any goods in credit, in future they will have receivables or payables, right? In foreign currency. Even if they have no MNCs, no subsidiaries, no joint venture, nothing, right? Intel buy all of its chips mostly from Ukraine. Even if Intel have no subsidiaries, no MNCs globally, their raw materials is coming from Europe, right? The entire world is dependent on Intel's chip, right? Even if they're selling from USA, the entire world will pay from their home country to Intel, right? So they should have in futures receivables or payables that needs to be hedged. That's one of the more important reasons why corporations do forecasting. Second important reasons. Sometimes corporations have excess cash. Excess cash. Which they can invest in short-term deposits, right? They can think of investing in USA or outside. If they want to invest in outside, it's not about only interest rate. What else they need to think of? Other than interest rate, what else they need to think of? Exchange rate. So that's why if corporations have excess cash, which they can invest in the home country or foreign country, because foreign countries sometimes could offer more interest. So they have to always think of not only interest rate, but also the future movement of the exchange rate between the home country and that foreign country. Capital budgeting decisions. If any corporations invest today for any subsidiaries, in future, what they should expect from the investments? If any corporations invest or initiate a new subsidiary outside of USA, they have to invest today. And what is the expectation in future? Nothing, no expectation in future, or they will receive something in the future. There's expectation. So let's say you purchase the land that you're going to use for parking. So if you buy it today, what is the expectation in future? If you rent it different people for parking, what is the expectation in future? Are you going to receive something or not? Yes? What are you going to receive? Money, cash flow, right? So in future, cash flow, are this cash flow in home currency or foreign currency? Foreign currency. So that means say, if any corporation have MNCs or subsidiaries in future in foreign country, if they invest today, in future they're going to receive purely cash flows. For that, they need to understand what should be the expected exchange rate. They need to forecast the future exchange rate. Now, if we extend this example, investing today, receiving earnings, future, right? If the earnings is coming from foreign country, what the company can think of this? The company can think of put the money there or take back the home country, right? Two options. If my foreign subsidiary is generating regular cash flows, regular earnings, being the parent company, I can decide keep the money with them, they can use it for further, or I can decide do not keep the money with them, take the money back to the parent company, right? For our usage. In that case, what is an important factor here? Exchange rate. So these are the reasons. These are the reasons why firms need to forecast exchange rate. Now let's say one final reason. Corporations need to raise capital. Corporations need to raise capital. What are the sources of capital for any corporations? Huh? That's it? Only bonds? What are the sources of capital? Absolutely. Equity and bonds, like you can think about equity or stock, debt or bonds, right? So if any corporations raise capital, they can also go for bank loans, right? They can also go for bank loans. If they raise capital today, they have to pay back in future. So this is another reasons why it is important to forecast exchange rate. So far, what we learned from chapter 9, all these reasons are nothing new. This is basic principle of finance concept. But as I said in the very first class, most of the concepts we borrow from corporate finance and physical finance class, but we learn all of this concept in the context of international finance. And the major key difference gonna be exchange rate between the countries. And that gonna affect all of our decisions. And that is the reasons we need to forecast foreign exchange rate. What are some, yes?
So I would say it's back to exchange rates decrease to increase the cost of capital, to increase the firm's value.
Say that again.
So the last one, so the MSA is that the exchange rates go down,
Which one you're talking about specifically?
cost of capital is go down.
So basically, when you talk about the value, okay? This is the value thing, right?
Yeah.
So basically, the thing is that when you talk about the value, right? Cash flow discounted by the cost of capital, very cost plus, right? So we learned that MNC need to decide how can we increase cost of capital, how can they decrease, sorry, how can they increase cash flows, how can they decrease cost of capital, okay? So this graph is trying to say that if you want to issue, this one specifically, if you want to issue bonds in home country and you have to issue at 10%, on the other hand, if you go outside, want to issue the bond, and if you issue at 7%, which one is better? Issuing at home country or issuing at outside? Which one is better? 10%, 7%. MNCs have to think about how they can increase cash flows and how they can decrease cost of capital. If foreign countries offering lower rate for cost of capital, they should go outside to issue all those capital to foreign countries. At the same time, they have to be careful going forward. When all those cash flows gonna happen, exchange rate should not move adversely so that their value is the maximized. Make sense? So you can think about this is the time value of money problem. How do we calculate present value? Can you remember? So in time value of money, we call these discount rate, right? Or rate of return, right? Or equal, right? So this is the cost of capital in this concept. Simple. Present value or value is basically cash flow discounted at equal rate discount rate. Rate of return, right? Right, Will? You're taking the principal finance class right now? Same concept. So if you only talk about this equation within the home country, equation is very simple. We don't need to think about exchange rate. But when you go in the context of global countries, we have to think about exchange rate. Does it answer your question? Okay, good questions. Techniques to forecast exchange rate. The first one is technical analysis. Any idea what is a technical analysis? No idea. Okay. Do what? What? Almost there. Use historical data to predict tomorrow. When we say technical analysis, historical data. In this context, historical exchange rate. Predict future values. In this context, predict future exchange rate. In general, it works for short-term periods, but the key thing here, technical analysis is not based on any kind of fundamental theories. It's just some sort of statistical analysis that trying to predict the chart movement. I repeat, technical analysis is not based on any kind of fundamental factors. What I mean by fundamental factors, if we say inflation is more in US, it has an implication, right? It has an implication, right? Because people in US move to outside to buy goods and services. There is a fundamental theory behind that because people or consumers prefer buying cheap goods. Fundamental theory behind that. So if exchange rate move due to inflation changes, interest rate changes, those are fundamental factors. There are theories behind that. Why people should move, why people should react if those factors changes. However, technical analysis is not based on that. It's not based on any fundamental factors or fundamental theories. It only based on chart movement. It's trying to look at previous chart movement. Based on that, it's trying to tell you what to do. Some good sources, I should say open sources or free platform to do technical analysis are TradingView and StockCharts.com. So if you just Google, let's say TradingView. And if you go to the markets, Forex market, pound, USD, this is like a time chart or line chart. This is known as candlesticks. Any idea how to interpret candlesticks? Candlesticks basically gives you the idea for each day, what is the open, what is the low, what is the high, what is the close. If I do the same thing on the stockcharts.com, like GBP, USD, same graph. Did you see that? Candlesticks, they look like candles. Candle and stick. So that's what's called candlesticks. So they're trying to tell you, let's say, if we talk about this one only, okay? It's a red one, right? So red means price goes down on that day. This point where the solid ends, open on that day. Another solid ends, close price on that day. Max sticks, which is here, is the high price on that day. Lowest sticks here, lowest price on that day. If it was a green candle, that means price went up on that day. So candlesticks trying to tell you at what price trading begins, what price trading closes, and what is the highest and lowest point the price touches on that day. And depending on the candle shape, you can predict what should be tomorrow. There is no fundamental theory behind, only candle movement, candle shape. That's it. No fundamental theory. If you look at this graph, you can just predict what's going on. Lot of technical indicators are there that help you to predict what should be tomorrow. Going back to TradingView graph. If you go What is the technical here? Technical tab. Thousands of technical indicators. Did you see that? Indicators name, indicators value, and the decision. So based on RSI, neutral, that means don't buy, don't sell. Now, based on this momentum, decision is sell. Based on this MACD, moving average convergence divergence level, so buy decision. So technical indicators give you the decision, buy, sell, whatever you want to do tomorrow, but not based on fundamentals. It's just the chart shape and chart movement. If you want to invest in stock, like home country stock, technical analysis is a really, really good place to start. There is no fundamentals behind it, but it can give you some easy money, easy problems. These are the two open source websites. You can go, you can do the technical analysis for any instrument, any stocks, any bonds, any currencies you want. And they will try to tell you what's going on. So ideally, what is the usage? What is the usage of technical analysis? Let's say any MNCs want to invest. Let's say there's an MNC in USA want to invest in UK today. And they want to invest for short term. Be careful. Technical analysis works better for short term. They don't work good for long term, okay? They want to invest for, let's say, money market instruments for 1 month only. Money market instruments for 1 month only. If you look at all of these indicators, average expectation is neutral. That means currency may not move a lot. So in that case, our learning objectives, in that case, if the MNC in USA want to invest in UK for 1 month, they may need to worry about a lot for the exchange fluctuations, because technical analysis is trying to say that in the short term, you can be neutral on the movement. Make sense? So there's implications for us. But again, it's not based on fundamental theory. Okay? So we cannot be a good proponent of using technical analysis. Questions so far? Now, as we are talking about, it works for short-term periods, and sometimes it may not work for long-term period. And also, you have to be careful. When technical analysis works better. So basically, you have to think about efficiency. Market efficiency. Do you know what is market efficiency? Do we know what is market efficiency? From our memory only. from our memory, what is market efficiency?
So, it's generally efficient.
Is this market efficiency? Price market is generally efficient. What is the definition of market efficiency? No idea. Students taking investment class. Let's say today you want to buy an asset, okay? You have to pay the price, right? Any asset you want to buy, it could be foreign currency, it could be stock, bonds, whatever, right? We have to get the price right. What this price indicates? What is the implication of this price?
All that information that we use in the market.
Absolutely. So when you talk about the price, we talk about the price at the market is at fair value, right? Fair value, right? So when you say any asset is traded fair value in the market, that means price should reflect all the information price should reflect all the information, right? Price should reflect if any changes in inflation, changes in interest rate, if any changes in expectation is coming or not, right? All the information. And market is three different forms of efficiency. Weak, semi-strong, strong. When price reflect only historical information, historical, weak form of efficiency. When price reflect on all the publicly available information, all the public history and in future, semi-strong. When price reflect all history, public and private with private information, that is called strong form of efficiency. So the idea is price is an indicator of fair value, right? And fair value should reflect information related to that asset. Information could be various types. There could be historical information. There could be all historical and all public level informations. There could be historical, all public, all private information. Depending on that, market could be weak, semi-strong, and strong form of efficient, right? So if you only talk about weak, so weak means that price reflect all the historical information, right? If price reflect that, market is weak form of efficient. And when market is weak form of efficient, using a technical analysis, we can easily forecast what is tomorrow. Makes sense? Because everyone use historical information, historical price and data to think about tomorrow. On the other hand, if market is not weak form of efficient, it should not be a good predictor. Make sense? So, long story short, technical analysis. This is a kind of analysis that try to look at history and predict tomorrow. So let's talk about very briefly about fundamental forecasting, and we're going to talk about in details fundamental forecasting in the next class, but just to talk about very briefly. So when we say fundamental forecasting, so fundamental forecasting means we have to find out a fundamental factor. What are some fundamental factors? Inflation, interest rate, income level, government controls, and expectations. So when we try to accommodate all of these factors and want to predict what should be the forecast for an exchange tomorrow, then this is called fundamental forecasting. So the idea behind is all these factors have a direct relationship with the spot rate, right? We know that if inflation goes up, how should be the impact, right? We know that if income level goes up, what should be the impact, right? So in fundamental forecasting, we basically know if any of these factors changes, what is the implications. And fundamental factors actually give you better future, better forecasting for future than technical analysis. And the implication is same. If you want to invest today in foreign country, and based on the fundamental forecasting, if you know what should be tomorrow, that actually help you to decide, should you make the investment today or not? Make sense? So we're going to talk about fundamental forecasting in more detail in the next class. So that's all for today. See you all on the Thursday.